Hi, this is Bill Polous from Profits Run, and welcome to the training where you're about to discover how to potentially turn $5,000 into $60,000 in 6 months trading options. And by the way, congratulations to you for making the decision to get this training. What you're about to discover could dramatically change your financial future. The information you're going to learn in this video is unlike anything you've probably seen before. So make sure you pay attention and take notes. I'm excited to get started. Also, it's very important that you watch this entire video. So please make a commitment to yourself right now that you're going to do just that. You've already invested in this training, but the only way you can see real results is if you watch this training and then implement what you learn. And I think you're going to be surprised by what you see, including a peek inside one of my brokerage accounts, so you can see how this method works in real life. I'm giving you everything you need in this video so that you can get started with this approach tonight. Okay, we're going to get started, but before we dive into the training, I want to read this important disclaimer. Futures and options trading have large potential rewards, but also large potential risk. You must be aware of the risks and be willing to accept them in order to invest in futures and options markets. Don't trade with money you can't afford to lose. This is neither a solicitation nor an offer to buy, sell futures or options, nor representations being made that an account will or is likely to achieve profits or losses similar to those discussed in this video or on this website. The past performance of any trading system or methodology is not necessarily indicative of future results. And then CFTC Rule 4.41, hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. So no representation is being made that any account will or is likely to achieve profit or losses similar to those shown. All trades, etc., discussed in this video or website and the product materials are for illustrative purposes only and not to be construed as specific advisory recommendations. Now, this is important for 3 reasons. First, it is actually required by the government. And second, there is risk of trading in any kind of market or in any kind of trading or investing. If there wasn't, there'd be no opportunity for profit potential. Just think of a certificate of deposit at your local bank. There's practically no risk there. But you only get paid 0.5% after 1 year, if that. So where there's profit potential, there's going to be risk. Third, in order to really go after the profit potential, you need to get educated. And you need the appropriate level of trading education. Without it, it's unlikely that you'll be able to overcome the risk. So with that caution, let's get right into the training. But first, let me very quickly introduce myself in case you're unfamiliar with me and my background. Again, my name's Bill Polous, and I've been trading the markets since 1974. It's my passion. It's what I love to do. I think I was attracted to trading in the first place because of my background as an industrial engineer, which is the field of study that I got my first degree in. I learned how to create, test, and perfect systems. For many years, this is what I did in my automotive career. That was my day job. But my night job was trading the markets. After I got my MBA from the University of Michigan, I thought it might be fun to start a business one day to teach people what I knew about trading. Well, that dream finally came true for me in 2001 when I started my financial education company, Profits Run, along with my son, Greg. We literally started it from the kitchen table, and now, over 10 years later, we have a modest office and over a dozen full-time employees that have helped us train over 50,000 regular people from all around the world on how to become better, smarter, and more effective traders. From the beginning, my goal was to simplify trading so that everybody could have a real shot at potentially creating some extra income in the markets. And I think my teaching hits home with a lot of people since so many of them keep coming back to us for more and more training. So I'm glad to have you here with me today, and I hope you pick up some useful techniques. Okay, now let's jump right in and talk about how it's possible to turn $5,000 into $60,000 in 6 months. First, I'm going to give you an overview of the trading plan, and then I'm going to dive deep and show you step by step how to implement it. To do that, we have to understand our trading goals. And here they are. We're going to use 1 or 2 strike in the money options with at least 45 days until expiration. We're going to trade options on the S&P 500 stocks that are priced at less than $40 per share. We're going to apply proper risk management, and we're going to apply a simple trading method that gives you a decided edge. And then you'll want to increase your position size as your account grows. Okay, let's take the first goal. Use 1 or 2 strike in the money options with at least 45 days until expiration. We're going to be directional trading short-term swing moves in the markets. And so we want to select in the money options to limit risk and also to track the movement of the stock price 60 to 80 cents on the dollar. So if the stock goes up $1, our option will go up 60 to 80 cents. And we want to select options that have at least 45 days until expiration to minimize theta decay or time value decay. And I'll talk more about this in a little while. Next, we want to trade options on S&P 500 stocks that are priced at less than $40 per share. Trading options on stocks less than $40 per share allows you to select lower cost options and therefore more contracts per trade. Now, there are over 100 stocks in the S&P 500 that trade for less than $40 per share to choose from. So there will be plenty of trading opportunities. Now, this is the most important goal of all, applying proper risk management. Proper risk management is a must. Without it, you will lose. With it, you have the chance to do very, very well. Now, when I'm talking about risk, I'm talking about the amount you would lose on a losing trade, not the amount you paid for the option. And so the risk per trade should be no more than 5% of your account size. For example, with a $5,000 account, you would risk no more than $250 on the next trade. Furthermore, you want to plan on losing no more than 50% of the price you paid for the option. That means you can buy $500 worth of option contracts and sell your options at $250 if it's a losing trade, netting a loss of $250. Now, if one option contract costs $200, for example, then you could buy a maximum of 2 contracts. Why? Because you take the $500 that you could apply to the next trade, divide that by $200 per contract, and that tells you you can buy up to 2 contracts. And let's say you bought those 2 contracts times $200, that'd be $400. If that was a losing trade, you would sell those options for $200. Having paid $400, you would lose $200, which is within your risk management parameter of, in this case, $250 or 5% of your account size. Now, as your account size grows, you can then add more contracts on future trades, but not before. You always have to follow the 5% rule. Okay, next is apply a simple trading method that gives you a decided edge. Now, I'm going to teach you such a method in just a moment. You have the potential to average 80% gains on winners and 40% losses on losers, and win 2/3 of the time. Now, that is really an excellent performance level, but it is possible. Now, by entering into 2 trades per week and achieving the above performance, you do indeed have the potential to turn $5,000 into $60,000 in 6 months. Now, of course, that is not guaranteed, but the potential is there. And you're risking a maximum of 5% of your account size along the way. So you're not taking wild bets to achieve this. So that would be 52 trades, which is easy to do given the fact that there are over 100 stocks to choose from that meet our stock selection criteria. Now let's look at some data. This data assumes that you make 2 trades a week and that your performance levels average 80% gain on the winners, 40% losses on the losers. That's the average. Some gains are going to be a lot higher. Some losses are going to be higher, not a lot higher. And some losses are going to be lower. Now, at that performance level, on average, you would be able to achieve a 10% gain on your account per week. So if you started with a $5,000 account at the end of week 1, your account would grow to $5,500. And then as your account size grows, you can trade, as I said, larger position sizes, more contracts, which will escalate the growth of your account, as you can see here, week by week by week. So here are the first 13 weeks after beginning with your $5,000 account. You're up to $17,261. Now, it isn't going to come in actuality this smoothly week after week after week. Some weeks you're going to do a lot better, some weeks not as well. But this gives you an idea of what is achievable. And looking at the last 13 weeks, you can see at the end of 26 weeks, your account size would stand at $59,590.88. Now, nobody can promise you this kind of performance. All I'm trying to do here is open up your mind to accepting the potential that exists properly trading options with proper risk management. Okay, with that background now, I'm going to show you several chart examples that I'll use in teaching you a simple trading method that indeed would give you a decided edge. And an edge means that you have the odds in your favor. Does not mean you're going to win on every trade. That's why you have to pay attention to risk management. But it does mean that over a series of trades, the odds are in your favor. And now I'm going to show you several chart examples to teach you how this all works in practice. Okay, here is a stock symbol OKE. This is a daily chart, compliments of freestockcharts.com. And this is an S&P 500 stock, and I'm going to be showing you some examples here where the stock price may be a bit over 40, but then later on, you'll see the stock sells off below 40, but the trading technique I'm going to show you doesn't care what the price of the stock is. The only reason we care about it is we'd like to be trading lower cost options. So the lower the price of the stock, the lower the cost of the options as a rule. Okay, here's the technique. It's very simple but very powerful. And let's just look back here. This red line is a 50-day simple moving average. And the blue line is a 20-day simple moving average. And down below here we have the stochastics %K with an 833 setting. And a stochastics indicator is an oscillator that tells us when the market is overbought, when the stochastics is on the high side, and oversold when it's on the low side. Now, what we're going to do is focus on first the 50-day moving average. So in order to take advantage of a downward trending stock, we want the stock price to be either below the 50 moving average. That's requirement number one. Number two, the stochastics %K must be greater than 60. And right here, in this particular case, you can see in the pop-up window, it's actually at 95, so it's well above 60. So I want the price to be below the red 50-day moving average. I want the stochastics to be above 60. That means the stock is rallying in an otherwise downtrend. And so I want to be looking to buy a put option, which is the right to sell the stock after the stock has rallied. So I'm going to be wanting to buy a put option right in here, and I'll show you an example of that in a moment. You can see that after this bear market rally, the stock then sold off dramatically, which would have given us a very, very profitable trade. Now, what about the 20-day moving average? Well, this is kind of a filter that says if the 20-day moving average is also below the 50-day moving average, that gives you the stronger setups. But that is not an absolute requirement, but it will give you the stronger setups. Once the stochastics is above 60, you track it each day until it drops 5 percentage points from its highest value. So in this case, It was at 96.66. You can see that in the pop-up window. Then 9651, then 9854, 954992, 83, right there. Now that's more than a 5 percentage point drop from the high of 98. And that's where you would buy the put option, right there. Now then we're going to risk half the value of the put option. If the market keeps going up, the put option is going to lose value. And if our put option drops in half, we sell it and take our loss, around 50%. If on the other hand, the market cooperates and moves back down, that put option is going to go up very significantly. It can go up 50%, 100%, 200%, even 300%. And a simple rule as to when to sell your put option for a profit is just wait for a close above the previous day's high, like occurred right here with this green candle. But only after the percent K is below 40. So in other words, I want the percent K to start dropping once we're in the position to below 40, and then I start looking for a close above the previous day's high, which occurred here. So this would have been a dramatic gain on this trade. Now let's stop right here and go to a good options broker trading platform and take a look at put options. Okay, here I'm at the Options Express trading platform looking at the option chains for OKE. And this is the current pricing of options with OKE trading at $38.92. So what I've done is I've typed in symbol OKE. I want to look at puts. I'm looking at the November expiration because that gives me at least 45 days until expiration. I click on View Chain, and that brings up the options table. Now, because in this case, OKE is trading at $38.92, I want to trade a 1 or 2 strike in the money option. That means an option that is priced with a strike price above the current selling price of the stock. For example, $40 option. And for this option, you can see the bid-ask price, $2.80, $3.90, which means that if you're buying this option at the market, you're going to have to pay $3.90. If you're selling this option at the market, you would have to accept $2.80. But when you're placing an options order to buy, you never want to pay the asking price. And you won't be able to buy it at the bid price, but you can usually buy it in the midpoint between the bid and the ask. In this case, about $3.30. Now let's take a look at, well, why not buy a $30 put? You only have to pay 10 cents, 50 cents, or they split the difference, 30 cents. Why pay all this money when you can buy one for 30 cents? Because the 30 strike put is what you call an out-of-the-money option, meaning in order for this option to have real value before expiration, the price of the stock would have to fall from $39 all the way down to well below $30. That's not likely to happen, and that's why this option is priced so cheaply. This one, in all probability, will expire worthless. So you don't want to buy that one. We want to buy the 1 or 2 strike in the money. And here's why. Let's click on Calc. And that brings up what is called the trade and probability calculator. So here's our symbol, our month, our strike price of 40, put. Let's say we want to buy one, and let's buy it at, say, $3.30, the midpoint of the bid ask, and click calculate. Now that brings up what's called a risk curve. This shows you the relationship of the profitability of the put option versus different stock prices. Right now, the stock's at about $39 a share, and we had to pay $330 for this put. Now, the November put option will expire the 3rd Friday in November. And if the price of the stock's trading at $40 at that time, this option will expire worthless. If it's trading at $41, it'll expire worthless. Anything above $40 will cause this option to expire worthless, and you would lose $330. Now, on the other hand, if the stock at expiration was trading at $36.70, this option would break even. Why? Because it would have $3.30 of real value. $40, which is the strike price of the option, less $36.70, the price of the stock, is $3.30. Why? Because when you buy a put option at $40 strike, that gives you the right to sell the stock, but not the obligation, at $40. So if the stock's trading at $36.70 and you have the right to sell it at $40, that gives you an option with real value of $3.30. Now, if the stock's trading down at $34, now your option's making good money and you've got a profit at $264. If it's trading at $30, you got a profit of $621, almost 200% from the $330 you paid for it. But it gets better. This is the risk curve at expiration. Here's what it looks like the day you buy the option. That's the green line. Because the day you buy the option, it not only has real value, it also has time value. For example, with the stock trading at $38.97, you buy a 40 strike put option. It has a real value at that time of 40 minus $38.97 or $1.03. But you paid $3.30 for the option, so it has additional value above the $1.03, or in this case, $2.27. That's time value. But that time value erodes as you get closer to expiration, and that green line will collapse into the blue line. So when we put the option on, it's the green line that's operative. Now, in order for us to make money, the next day, if that stock trading at $38.97 dropped to $36, which it could, you've suddenly got a $133 profit, or about 35% of what you paid for it. And if it kept dropping down to 32, now you're looking at a very big profit. $411, now you're over 100%. Now, if this trade takes a week or two to develop, and most of our trades, we're going to be in a week to 3 or 4 weeks, this is what the green curve would look like. You see, it didn't really drop that much. And so we get profitable a whole lot quicker than you would at expiration, as shown here with the blue line. Now, if the trade goes against us, the stock starts to go up in price instead of down. As soon as the value of that option drops 50%, right about there, you get out. Take your loss and go on to the next opportunity. Now, I hope you notice something looking at this curve. You have almost unlimited upside all the way until the stock goes to zero, but you have very limited downside. The stock could go to the moon and you could not lose more than $330. And you only plan to lose half of that. So with options, you have the power of leverage, but you also have limited risk if you buy the right option. In this case, a 1 or 2 strike in the money option. Do not buy the out of the money option. It's a very cheap option to buy, but it's cheap for a reason, because it's very likely that it will expire worthless and you would lose the entire amount you paid for it. Okay, while we're here, let's go back and look at a call option. Okay, I just type in calls, hit view chain, and that brings up my call option price table. And let's say I wanted to buy a call option because my trading method told me that OKE is likely to go up. So what do I want to do? I want to buy a 1 or 2 strike in the money call option which would be a strike price below $38.91. So in this case, I'd choose the $37.50 call option. That's one strike in the money. 35 would be two strikes in the money. 32.50 would be three strikes in the money. One strike in the money in this case is fine. So here's my bid ask, 230, 310. Now this bid ask, both on the put and the call in this example, is wider than I like. I usually don't want to see this bid ask spread more than 10% of the bid price. So when you encounter this, it's very important to never pay more than the mid price between the bid and the ask, so that you're not overcharged for the option. Okay, so let's click on the Calc button, and that brings up the trade and probability calculator for the call option. So let's buy one at $2.80, which is the midpoint. Click calculate. And that brings up the risk curve for a call option. And notice it's the opposite of the put option curve. The put option curve extended down here and then went up to the left. The call option goes in reverse. Why? Because when the price of the stock goes up, the call option is going to gain in profitability. If the stock price goes down, the call option is going to lose in price, but only to a maximum amount, in this case, $280. And likewise, the day you buy the option, it's the green curve that prevails because you still have time value in the option. And as the price of the stock goes up, you have the opportunity to make a great deal of money in a relatively short period of time. By the way, unless you're deep in the money on your option, it's a good idea to sell your option the first week of the expiration month, because the expiration month will decay the time value of that option rapidly, and that green line will collapse very quickly. So you don't want to hold the option that long. On the other hand, if you're deep in the money, meaning the stock has gone up a lot, then it doesn't matter much. You see the green line here is right on the blue line anyway. Most of the time value's already been pulled out of the price of the option. Okay, armed with that background, now let's go back and look at our chart example, applying our simple trading method for more opportunity. Okay, back to our simple trading method. This was the trade we initially reviewed, and now the market rallies. The 50-day moving average is still going down. Market rallies. The percent K is now above 60. It's at 80 something. And we wait for it to drop 5 percentage points. 80, 80, 74, right there. So we go ahead and buy a put option right there with the stock trading at $45, right in there. We wait for the percent K to drop below 40. And as soon as we get a close above the previous high, we get out. So in this case, you would have made a little money, but not much. But that's okay. You go on to the next opportunity, which is right in here. The percent K is above 60. It peaks at 86. It drops to 76 right here. You go ahead and buy your put option. And the market initially goes against the trade, but it won't stop you out. The put option will not lose 50% of its value with a counter move like this. Then you wait for the percent K to go below 40 and a close above the previous high right here, and you can sell your position with a very nice profit. Now, you don't have to wait for the exit rule to close above the previous day's high. You can sell your put option anytime you want. In other words, if it achieves about an 80% gain from what you paid for it, a good practice is to sell half and then let the second half ride until you get the exit signal. Okay, here now we've got the market trading above the 50. We've got the percent K below 40, because now we're looking at buying a call. And again, I want to see the percent K change by 5 percentage points. It's 30, it's 25, it's 47. Let's go back and check it. It's 40, it's 30, 25, 47 right there. So I go ahead and buy a call right in here. And let's just check it. That price is around $47. You'd be buying a 1 or 2 strike in the money call. In this case, either a 46 or a 45 strike call. Okay, now you wait for the market to rally. You can take your profit right in here. You can wait till the close below the previous low right there. And here you can finesse it a bit. If you don't have a big run up, you can sell half here, hang on to the other half, and wait for a final leg up and sell for even more. So that takes a little bit of finessing and experience, but if not, you could have still sold here for a nice quick profit. And you notice, I don't know, how many trades have we looked at so far? 1, 2, 3, 4 already for just one stock in a matter of a couple of months. So you can imagine how many trades there are available that set up according to this method when you look at the over 100 stocks that meet our stock selection criteria. So it'd be very easy to be able to average at least 2 new trades a week. Okay, then again, if you missed that trade, the stochastics came down below 40 to 36. You got 5 percentage points higher. You could have bought a call option right on the open there and sold it a couple days later for a little bit of a profit, not much. But you notice we're not waiting around. If it doesn't move in our favor right away, you just take whatever you can and get out. Okay, now the percent K is trading below 60. The market's above the 50 red simple moving average. Stochastics jumps more than 5 percentage points right here. You could buy the call right in there. And in this case, you would be closing out your call for 50% loss. But that's the first one like that out of several trades. Okay, that's going to happen on occasion. There's no way around that, but that's fine because we know the odds are in our favor. Okay, now the market's below the red 50. The stochastics is above 60. It drops 5 percentage points right there. You buy a put option now because we were looking at the market going down. We're below the 50. And you can see this trade following the exit rule to stay with it until you get a close above the previous day's high. You wouldn't have got out until right in here. This trade would have made probably about 300%. Keep in mind, we're not applying any other criterion. This is it. And look how these set up for you. Okay, here's another one. You'd buy the put right in here. You'd be out here for a small profit. But you'd buy another put here. You'd be out here for a better profit. This one here didn't go above 60. This one, 59.68, close enough. You'd buy your put here, out here for great profit, and so on. All right, let's look at another stock. Okay, this is stock symbol MU, Micron Technology. Again, compliments of freestockcharts.com. Okay, here's our red 50-day simple moving average. The market rallies, then sells off. Our percent K drops below 40, moves up at least 5 percentage points, and we go ahead and buy a 1 or 2 strike in the money call right here. With the stock trading at $32.75, we'd have bought a 32 or a 31 strike call. And then following our exit rule, the percent K has to be back up above 60, and we get a close below the previous day's low, and you could exit right there for a really fine profit, triple-digit profit. Again, the market sells off but stays above the 50-day moving average. The percent K drops below 40. It ticks up 5 points right in there. You could have bought a call right in there. and exited here for a more modest profit. But consider the percentage of winning trades. It can be very, very high. Now the market falls below the red 50. We get the rally right in here, above 60. We drop 5 percentage points. We can buy a put option now right in there. And we would exit right here for almost a wash. Not much going on there. And you can see you want to exit when the rule tells you to exit. There's no sense in hanging on a put option if the market has the potential to rally like this. Turning a small profit or a break-even trade into a big loser. You don't want to do that. So never be wedded to your position. Just because you have a position doesn't mean the market has to make you a profit. So you've got to be vigilant in applying these exit rules. Okay, and then you just wait for the next opportunity. The market rallies. It's still below the 50. And you wait for the percent K to drop 5 points right there. You buy your put option right in here. And you get a dramatic drop in a couple of days. You could have exited right on down here for easily triple digits. Again, if you see that happen, if the market gives you a gift like that, take it. Don't wait around where it just plummets like that in one day. Yeah, it went lower, but you don't know that that's going to happen back at this point in time. Then you wait around. You see if we get above 60. No, we didn't. Over here, we've got the market just above the downward sloping 50 moving average. The percent K has turned down, and the market's now closing below the 50. This is a higher risk trade at that point, but you could have bought one or two strike in the money put and had a pretty nice profit right in here. You exit that trade. And likewise, again here, you could have bought one or two strike put, and in this case, a very excellent trade. And so on it goes. All right, let's look at one more. Okay, let's look at PFE, Pfizer. Here's the 50-day moving average. Percent K right here drops below 40. Ticks up at least 5 percentage points. You buy your call option here. Market chops around, goes nowhere. And then our percent K moves on up above 60. And we start looking for our exit point. We get a close below the previous day's low, and we're out right there. Another opportunity to get in here. The percent K is back below 40. It ticks up. We're back above the 50. You buy your call option here, and you've got an easily triple-digit gain here, exiting right up here. I hope you're starting to get excited. Scrolling forward, we get a percent K below 40 right in here. We buy a call option. A lot of choppiness here, but we would have gotten out. Regardless of where you got out, it would have been a profit. Not a big profit, but nevertheless, a profit. Then the market sells off below the 50. It moves up above 60 on the percent K. And we get a chance to buy a put option right in here. Again, a lot of choppiness going on. Another chance to buy the put here for a pretty nice profit. Then we got the market rallying above the 50, percent K below 40. Moves up, you buy the call option for a small profit. And that's how you trade the simple trading method on the S&P 500 stocks that average less than $40 a share. It gives you the chance to buy the lower cost options. There are many, many, many setups so that it should be fairly easy to be able to, on average, enter into 2 new trades a week. Before we close out, I want to go back to the brokerage site and look at the option table for Micron Technology to make sure you understand how to read these tables. Okay, let's circle back now to the Options Express option chain quote page. And I've typed in symbol MU. And we're going to look at the calls, the November expiration, view the chain, and it brings up all of the prices for the different strikes. Now, I want to point out a few more things to make sure you have this clear. So MU is trading at 1841. Well, if you expect the market to go up, what do you want to do? You want to buy a call option. Which one? Well, you want a 1 or 2 strike in the money. That would mean either a 18 or 17 call. 18 is in the money because it has 41 cents of real value. 17 has $1.41 of real value, and consequently, it costs more than the 18 call. In this case, you could buy either one. Now, look over here. If I click on detail, a window pops up and it shows you in the middle at the top the delta, 0.59. That means that if Micron goes up $1 from 1841 to 1941, price of the option will go up at least 59 cents, probably a little more. That's the delta. Now, if you look at the 17 strike, the delta is going to be higher. You see, it's 0.71 because it's further in the money. So if Micron goes up $1, the option will go up 71 cents or more. Now, another thing to pay attention to is the open interest. Not the volume so much, but the open interest. Ideally, you'd like to have an open interest of at least 100 contracts. That means that's the number of contracts outstanding. Well, in this case, for the 18 strike, there are 3,200 contracts open. For the 17, 6,700 contracts open. So more than enough to give you the liquidity you need to trade this option effectively. And you notice with such high open interest, the bid-ask spread is usually a lot tighter than it was for the OKE example that we looked at. Where here you got a bid at $2.04, an ask at $2.10. If you wanted to buy, you'd split the difference, go in and buy it at $2.07, and very likely you would get filled. Now let's take a look at the put options, view the put option chain. And of course, if we thought Micron was going to go down in price, meaning our simple trading method's telling us that it's time to be buying put options, with Micron trading at 1857, we want at least a 1 strike in the money put. That means a strike price above 1857, or in this case, 19 or 20. And again, if you look at the 19, it has real value of 43 cents, the difference between 1857 and 19. The rest of the premium is due to time value. If we go over here and look at the delta, it's 0.52, minus 0.52. The 20 strike is more expensive because why? It has real value of $1.43. So it's going to cost more, and it's got a higher delta of 0.64. But either one of these would be a good choice. If your account size is smaller and you'd prefer to buy the lower cost option, then do so. If it's a larger, then you could buy the higher cost option, which will profit more quickly given a dollar move in the stock. But either one is a good selection. Now you see the open interest in this case is 25,000 contracts at the 20 strike, and at the 19 strike, only 107. That means somebody went in there and bought a lot of put options expecting Micron to drop in price. Now, if you consider the open interest, then that tells you that the 20 strike would be a better choice than the 19. You could still trade the 19. 107 is okay. It's just above the minimum that I like to consider. But with this one at 25,000, I'd be more inclined to pick the 20. Okay, then don't forget on any good broker platform, let's pick the 20 for example. Click on Calc. You should be able to do this with any good broker trading platform. The price for the 20 is 204.210. So let's go in and try and buy it at 207. buy 1, the 20 put, calculate, and there's the risk curve for the put. Until you get the hang of this and very comfortable with options, it's always a good idea to look at this risk curve so you can understand the relationship between the profitability of your position and the price of the underlying stock. Okay, basically that is all you need to know to have the potential to take a $5,000 account to $60,000 in 6 months. Now you've got one simple but very effective method for potentially growing your portfolio. All you need to do is spend 20 to 30 minutes per day scanning the 100 or so stocks that fit the criteria for this simple method, and a few more minutes identifying which stocks are currently showing the profitable setup situations I just showed you. Or you can make it much easier on yourself. Here's the deal. I prepared an exclusive VIP webinar training that reveals an unusual technique to go after fast profit potential in the markets. But instead of spending 20 to 30 minutes per day like you need to do with the approach you just learned, you can just spend 20 to 30 minutes per week with the unusual technique I reveal on this webinar training. In the past, I've charged up to $500 to attend trainings like this. But to thank you for investing with me, I'd like to give you free access to this exclusive training. All you need to do is click on the link below to register. However, I can't guarantee that this training will be free forever, so make sure you go and register below for it right now. I'm so excited to hear what you think about this free VIP training.